Singapore is heavily marketed as a global low-tax environment, and the public numbers support that reputation. The country operates on a progressive income tax system, with rates scaling from 0 up to a maximum of 24%. But those favourable rates are not universally applied. They are completely walled off behind strict tax residency rules established by the Inland Revenue Authority of Singapore, or IRAS. This split bar chart illustrates the stakes. On a $150,000 salary, an expat taxed under progressive resident rates owes significantly less than someone forced to pay the flat 15% non-resident rate applied to the exact same income. The margin for error here is 0. Missing the government's residency threshold by a single day completely rewrites your legal status and triggers that higher tax liability. For mobile professionals, effective tax optimization requires looking past the accounting ledger and focusing strictly on timeline manipulation. IRAS determines your tax status using a single binary metric, the day count threshold. This system tracks your physical presence. Every single day spent inside the country's borders compounds, constantly pushing you toward or past critical regulatory deadlines. An expat's tax tier is a direct product of their physical calendar. Depending on your exact day count, you will fall into one of 3 distinct tax zones. The first tier applies to short-term visitors. You fall into this category if your total employment days in Singapore remain at 60 days or fewer within a calendar year. Looking at this timeline, staying within this 60-day window secures a 0% tax rate. That count is exhaustive. You must include all weekends, public holidays, and even incidental overseas business trips in your total calculation. There is a major exception to this rule. Company directors, public entertainers, and independent professionals do not qualify. Holding these roles voids the 60-day exemption. Instead, you trigger a punitive 24% withholding tax on your income. Short-term visitors must rigidly lock their travel dates. Accidental miscalculation that push your stay today, 61 instantly trigger a massive liability. The second tier captures mid-length contracts encompassing anyone who stays in Singapore for a period between 2 to 6 months, specifically 61 to 182 days. Falling into this specific day count window dictates that you are categorized strictly as a non-resident for tax purposes. The financial penalty for this status is steep. Your employment income is taxed at a flat 15% or the progressive resident rate, whichever results in a higher tax amount. The secondary penalty cuts even deeper. Non-residents trapped in this tier are entirely barred from claiming any personal tax reliefs or deduction to lower their taxable base. With high flat rates and 0 deductions, accepting a 4 to 5 month contract is the least mathematically efficient decision an expat can make. The optimal tier requires engineering your employment period to exceed 183 days within a single calendar year. Once you cross the 183-day milestone, IRAS classifies you as a tax resident. The immediate financial benefit is full access to Singapore's favourable progressive income tax brackets, which start at 0%. Residents also regain the ability to claim deduction for business expenses, charitable donations, and personal reliefs. If your current contract places you in the non-resident danger zone, negotiating a short extension to cross the 183-day line is often the highest return on investment decision you can make during your time in Singapore. This timeline illustrates the 2-year administrative concession, arriving too late to hit 183 days before December 31st, working a continuous period spanning 2 years that totals at least 183 days grants resident status for both. For example, November through May clears the threshold. Keep in mind, this administrative concession explicitly excludes company directors, and independent professionals. By strategically timing an entry date late in the year, savvy professionals can manufacture tax residency and secure lower rates for 2 separate tax years. When you eventually relocate outside of Singapore and terminate your local employment, the regulatory focus shifts entirely to your exit obligations. You must undergo a mandatory tax clearance process known as filing an IR21. This is a formal notification to IRAS, and your employer is legally required to withhold your final funds until clearance is officially granted. Before you leave, you must pay all outstanding taxes in full and terminate any automated GIRO arrangements. GIRO is Singapore's electronic direct debit system, and leaving it active after departure can cause banking complications. Once you exit, you gain a significant post-departure financial benefit. Any foreign source income you derive while overseas and remit back into Singapore is largely tax exempt. There are strict exceptions to this rule. Overseas income derived from certain investments, pensions, or partnerships remains fully taxable and must be declared. Leaving Singapore creates a heavy, immediate administrative burden upfront. However, completing it properly provides a long-term tax shelter for your remitted global income. This quadrant chart evaluates the trade-off between effort and financial impact. The short-term traveller staying under 60 days belongs in the low-effort, high-impact quadrant. The mid-term expat requires high-effort, high-impact. The long-term resident falls into the low-effort, low-impact quadrant. The greatest mathematical vulnerability and the greatest opportunity for active optimization falls strictly on professionals working mid-length contracts. If you operate as a board director or an independent consultant, prepare for immediate 24% withholding taxes regardless of how few days you spend in the country. If you are arriving late in the year, meticulously plan your contract start and end dates to successfully leverage the 2-year straddle rule. Mastering these timelines provides a predictable path for wealth preservation. In the Singapore tax system, your effective rate is a direct product of your calendar. Missing 183 days by 1 day can cost you thousands. If your posting end date is coming up, WhatsApp me today at +65 975 01055 before it's too late.